The numbers are flashing, and I need you to listen closely. Right now, euro to US dollar is at 1.1428, up 44 pips on the session, ripping higher in the early London hour while the weekly chart is screaming strong sell. Think about that contradiction for a second. That is a trap being set in real time. And if you're not reading the levels correctly, you're going to get run over by the liquidity engine. There is one danger zone and one hidden opportunity right here. I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. This is the blueprint that separates the hunted from the hunter. Now, let's start with my instant market verdict. The session bias right now is a counter-trend rally inside a bearish weekly and daily structure. The 5-hour and 1-hour charts have flipped a strong buy, which tells us intraday momentum is real and it's driven by a fresh fundamental spark. Natixis coming out overnight saying the dollar rally has peaked, recommending clients sell the greenback. That headline hit, stops above 1.1400 got run, and here we are. But here's what most traders miss. The daily trend is still strong sell. ADX on the daily is printing a staggering 46.6. That is not a weak trend. That is a freight train that doesn't just turn on a headline. So the verdict, range-bound to cautiously bullish intraday, but with a heavy gravity ceiling not far above. The single invalidation level that flips the entire structure is 1.1476. Write this number down. If we break and close above 1.1476 on the 4-hour chart, the weekly downtrend is in serious jeopardy and the dollar killers, bond spreads and policy divergence, will have taken control. Until then, this is a bear market rally, and the herd is already piling in on the long side too late. That herd positioning matters because when the trap triggers, the liquidation will be fast and violent. The smart money is waiting at that level. So let's go to the technical deep dive. I want to walk you down from the weekly canvas all the way to the 60-minute execution chart, because the alignment here is rare. On the weekly chart, price is trading well below the MA20, the MA60, and the MA200. The moving average ribbon is in full bearish formation. MACD on the weekly is deeply negative and still accelerating lower. No divergence yet. That tells you the multi-month trend is down, and the recent price action has been a series of lower highs. Now step to the daily. Same bearish structure. Price is below every major moving average I care about. The MA20 sits at 1.1476. Yes, that exact number. And that's not a coincidence. That is the dynamic resistance that has capped every rally attempt for the last 2 weeks. The MA50 is at 1.1557, the MA100 at 1.1606, and the MA200 at 1.1571. Price is crushed below all of them. The daily MACD is negative at -0.007, but the histogram bars are shrinking slightly, hinting that bearish momentum is getting exhausted. RSI on the daily is 39, just starting to curl up from oversold, which supports a bounce, but still below the bear market resistance of 40 to 50. So the daily says, bounce for now, but the trend is your ceiling. Now, the real magic happens on the 4-hour and 60-minute. On the 4-hour, price has just punched above the MA20 and is challenging the MA60. This is the first time in 5 sessions we've seen that. The 4-hour MACD has printed a bullish cross, and this is the hidden divergence I mentioned. Price made a lower low at 1.13702 days ago, but the MACD made a higher low. That's bullish hidden divergence in a downtrend, often preceding a strong corrective rally. That's exactly what we are riding right now. On the 60-minute chart, it's even clearer. Strong buy signal, price above the MA20 and MA60, with the 20 already crossing above the 60. The hourly MACD is above the zero line for the first time in days. Williams %R on the 60-minute is near overbought, at -0.0068, which tells us the rally is stretched and a small pullback is due. That pullback will be our entry for Scalp 1. Now, here's what most traders miss at this 3-minute mark. They see the price surge and they chase, or they see the daily trend and they short early. Both are traps. The real opportunity is to let the structure confirm its breakout above the pivot area, and then use the new support zone for entries. Yesterday's pivot point was 1.1392, which the market has obliterated. The classic resistance levels are 1.1398, R2 1.1403, R3 1.1408, all vaporized. Those levels now flip to support. The new intraday support shelf is 1.1392 to 1.1403. As long as price holds above this zone, intraday longs are valid. A break below 1.1381, that's the S1, would void the bullish bias and suggest the trap already sprung the other way. So keep that number 2. Now let's connect the fundamental driver and cross-link this to the broader macro picture, because without this, you're only reading half the story. The 24-hour core news is Natixis saying the dollar rally has peaked and recommending clients sell the greenback. But I need you to read between the lines. The analyst consensus we track still says the advantage remains with the dollar, that USD will remain in a strong position. That's a discrepancy. When a major institution calls a peak while the street is still long dollars, you have the ingredients for a violent regime change. The US-German bond spread, the true euro-dollar engine, has started compressing. The 2-year yield differential narrowed 5 basis points in the last 2 sessions. That's a significant shift. If this compression continues, the euro gets a fundamental bid, and the weekly trend could genuinely crack. But for now, we trade the technical reality. The 1 to 2 week directional lean. I am cautiously lower on euro to US dollar unless 1.1476 is taken out. That's the line in the sand. That level corresponds not just to the MA20 but also to a previous breakdown point from 2 weeks ago. A close above there opens the door to a retest of 1.1557, the MA50. Failure at that level, and we're revisiting 1.1370 and then 1.1300. I need you to interact here. Do you think the dollar breaks 105 on the DXY this week? Comment yes or no. I'm tracking consensus from this community, and it tells me where retail is leaning. Alright, now we enter the section that most people skip, and that's exactly where the money is made. Keep watching. I'm giving you 3 trade setups, 2 scalps for the fast twitch traders, and 1 swing plan for those who want to hold through the noise. Let's start with scalping strategy number 1, the opening scalp. This is a high probability long from the new support shelf. Here's the exact play. Price is at 1.1428 right now. We expect a pullback as the overbought hourly conditions cool off. We wait for price to tap into the 1.1403 to 1.1392 zone. That's the old resistance now. Support. Once price prints a bullish engulfing candle on the 5-minute chart right at that zone, we go long. Entry is at 1.1395 with a very tight stop loss at 1.1380. That's just below the S1 level and below the pivot. The risk is 15 pips. Take profit 1 is at 1.1430, which is 8 pips above current price but will likely be reached on the bounce continuation. That gives a risk-reward of about 1 to 2.3. If momentum really kicks, take profit 2 at 1.1450. This scalp is void if the 5-minute candle closes below 1.1390 with conviction. Fast, clean, and based on structure. Here's the on-screen trade card for this 1-dot strategy. The opening scalp, long, entry, 1.1395, after 5 minutes bullish engulfing in the 1.1403 to 1.1392 zone, stop loss, 1.1380 take profit 1, 1.1430 take profit 2, 1.1450 risk, reward, 1:2.3R, to TP1, invalidation. Void if 5M candle closes below 1.1390 with volume spike. Now the second scalping setup is the one that exploits the trap directly, the liquidity grab. This is a counter-noise play for when the market fakes out the late longs or late shorts. Here's the idea. The most obvious stop-hunt zone is just above the Asian session high, which is around 1.1440 to 1.1450. The crowd sees the break and buys the momentum, but we wait for the fake. If price pushes above 1.1450, grabs liquidity, and then immediately reverses with a bearish engulfing on the 5-minute back below 1.1445, we short that. Entry is at 1.1440, with a stop loss placed just above the wick, let's say at 1.1465. That's 25 pips risk. The target is the nearest intraday liquidity pool, which is exactly that 1.1400 level we discussed. So take profit is 1.1405. That's a 35 pip profit for 25 pips risk, a solid 1 to 1.4 ratio, but with a high win rate because you're trading the exhaustion. Warning: this requires fast execution and you must not hesitate. Once you see the 5-minute candle close back below the breakout level, you enter within seconds. If the breakout holds and we get a 5-minute close above 1.1460, this scalp is void. Here's the trade card strategy: the liquidity grab, short, entry, 1.1440, after fake breakout above 1.1450 and 5M bearish engulfing closes below 1.1445, stop loss, 1.1465 take profit 1.1405 risk, reward, 1:1.4 invalidation. Void if 5M candle closes above 1.1460.at this moment. I want to ask you directly, are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. I read every comment, and I'll adjust tomorrow's plan based on what the community bias tells me about the retail trap. The wisdom of the crowd is often the contrarian signal now. Third strategy is for those who have patience and want to align with the higher time frame reality, the session swing. This is a swing short designed to capture the weekly downtrend resumption, assuming the trap at 1.1476 holds. Here's the trigger. We wait for the 4-hour candle to approach and stall at the 1.1476 to 1.1485 zone. That's the MA20 and a prior order block. We do not enter until we see a rejection. The trigger condition is a 4-hour bearish engulfing candle closing back below 1.1470, with the 4-hour MACD rolling over from an overbought-like position. Entry is at 1.1465, just under the broken intraday high, confirming the rejection. Stop loss goes outside the daily structure above the MA20 and the recent swing high, specifically at 1.1520. That's a 55 pip stop. The conservative swing target, take profit 1, is 1.1400, which is where the hourly support shelf and the former resistance sit. That's a 65 pip gain, giving a risk reward of 1 to 1.2. The stretch target, take profit 2, is 1.1370, the recent swing low. That's 95 pips, offering about 1 to 1.7. Once price reaches halfway to TP1, around 1.1430, we trail the stop to break even. That protects against any sudden dollar negative headline. Invalidation for this swing, a daily close above 1.1490. That would shift the medium-term outlook and potentially set up that bullish breakout we talked about. This is how you sell strength in a bear trend without getting chopped up. Here's the final trade card strategy, the session swing, short, entry, 1.1465, after 4 hours bearish engulfing closes below 1.1470 at the MA20 resistance, stop loss, 1.1520 take profit 1, 1.1400 take profit 2, 1.1370 risk, reward, 1:1.2R, to TP1, 1:1.7R, to TP2, invalidation, void if daily close above 1.1490. Risk management pulse. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. If you're risking more than 20 pips on a scalp, you're doing it wrong. No positions through high-impact news. And today we have ISM data later. Stops are non-negotiable. This is how you survive to trade the next big move. Now let's close the loop and give you tomorrow's wildcard. The single most critical level for the next session is 1.1476. Everything revolves around it. If this level breaks and holds, the entire monthly trend flips from neutral to a genuine buy, and the dollar collapse narrative becomes the front page story. If it rejects, we are headed back to 1.1370 and likely lower. Tomorrow's focus will be the US Services PMI and the reaction in the 2-year yield. I'll have an updated blueprint exactly 24 hours from now, breaking down whether the trap has sprung or the breakout is real. If you want the full breakdown on Bitcoin and the S&P divergence, because that risk asset linkage is flashing its own warning, that video is live now. Tap the end screen to watch it next, and I'll connect how the euro to US dollar trap and the S&P gamma levels are intertwined. Then hit the bell so tomorrow's alert lands before the London Open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter before the market moves. I'll see you in the comments. Post your scalp or swing plan and I'll pin the best one.